Today, we will talk about growth rates, formula, how to calculate, and definition. Growth rates refer to the percentage change of a specific variable within a specific time period. Growth rates can be positive or negative, depending on whether the size of the variable is increasing or decreasing over time. Growth rates were first used by biologists studying population sizes, but they have since been used in studying economic activity, corporate management, or investment returns. At their most basic level, growth rates are used to express the annual change in a variable as a percentage. For example, an economy's growth rate is derived as the annual rate of change at which a country's GDP increases or decreases. Growth rates can be calculated in several ways, depending on what the figure is intended to convey. A simple growth rate simply divides the difference between the ending and starting value by the beginning value. Economic growth rate for a country's GDP can be computed using a specific formula. The compound annual growth rate is a variation on the growth rate that is often used to assess an investment's or company's performance. This calculation assumes that growth is steady over a specified period of time. Financial theory suggests that a company's shares can be fairly valued using a dividend discount model, based on the hypothesis that present-day price is worth the sum of all of its future dividend payments when discounted back to its present value. Growth rates are utilized by analysts, investors, and a company's management to assess a firm's growth periodically and make predictions about future performance. Most often, growth rates are calculated for a firm's earnings, sales, or cash flows. Specific industries also have growth rates. Each industry has a unique benchmark number for rates of growth against which its performance is measured. Industry growth rates can be used as a point of comparison for firms seeking to gauge their performance relative to their peers. Say that we are comparing the annual growth rates of two countries' GDP. We can look at the annual growth rates of each country for the first 2 years, and then consider the CAGR of the two countries over the 2-year period taking place between years 1 and 3. While growth rates are important for understanding how things change over time, they do come with some important limitations. Growth rates only consider the net change between 2 points in time, and ignore the nominal amounts involved. They are also hard to compare across industries or other unlike variables. The GDP growth rate, according to the formula above, takes the difference between the current and prior GDP level and divides that by the prior GDP level. What is considered to be a good growth rate for a company will depend on several factors such as the industry it is in, whether it is new or well established, the size of the company, and the overall condition of the economy. Startup companies, especially those in high-tech industries, are expected to grow quite rapidly. For Y Combinator companies, a good growth rate is considered to be 5% to 7% per week of revenues, while an exceptional growth rate is 10% per week. Growth rate calculations can be easily transported into a spreadsheet program like Microsoft Excel to speed up calculations and remove the chance of human error. Like any other growth rate calculation, a population's growth rate can be computed by taking the current population size and subtracting the previous population size. Divide that amount by the previous size. Growth rates measure how quickly variables increase or decrease, showing the net change in value over some period of time. Calculating a growth rate is simply achieved by dividing the difference in value observed over some period by the starting value. Here are 5 key takeaways. 1. Growth rates are used to express the annual change in a variable as a percentage. 2. A positive growth rate indicates a variable is increasing over time, a negative growth rate indicates that it is decreasing. 3. Growth rates can be beneficial in assessing a company's performance and predicting future performance. 4. Growth rates are computed by dividing the difference between the ending and starting values for the period being analyzed and dividing that by the starting value. 5. Time periods used for growth rates are most often annually, quarterly, monthly, and weekly. Hope this would help. Thanks for watching.